Welcome to this quick tutorial about stock issuances for cash. First of all, why do companies issue stock? Basically, they issue stock to raise large sums of money for various projects. The first time a private company issues stock to the public, it has an initial public offering or an IPO. Let's compare debt to equity. There's several comparison points. I'm just going to do some major points here. First of all, debt financing. Debt issuance, also known as loans. The advantage of this is that control or ownership of the company is not given in exchange for the cash received typically. The big disadvantage to debt financing is that it can be expensive. You have to pay principal and interest on debt, and you also have to pay it back ultimately at the end. So it's considered to be more risky. So those are major points about debt financing, certainly not all of them. But let's look at equity, which is what we're looking at here, is stock issuance. So when we do an IPO or a later stock issuance, why would we want to do that? Well, first of all, the advantage is that you don't need to make any principal or interest payments ever have to be made on this. The big disadvantage is that ownership or control is given in exchange for the cash. So when you issue stock, you're giving away part of the ownership of the company. Again, those are just some major points about the advantages and disadvantages of debt financing versus equity funding. And there's a lot more, but those are major points. Let's go through some examples now. What happens when we issue common stock at par for cash? So in our example here, September 4th, Kingston Corporation issued 1,000 shares of its common stock. The issue price was $1 per share, which is equal to the par value of the stock. This is probably the easiest situation we have, probably not the most common at this point or the most frequent we see. And what we're going to do here is we're going to debit cash because cash is increasing, and the amount will be the 1,000 shares times that $1 per share par value or price, and that's $1,000. The other side of this transaction is going to be common stock. Common stock gets the full 1,000. Common stock gets the par value of the transaction, and that is to issue common stock. So what impact does this have? It increases assets, that cash increases assets, and then the other side of this will be to increase stockholders' equity. So that is example one, which is issuing common stock at par for cash. Now let's look at issuing common stock at a price above par for cash, and this is the most frequent thing that happens. On October 3rd, Korner Corporation issued 1,000 shares of its common stock, which has a par value of $1 per share. The issue price was $20 per share. We're going to start by debiting cash because we know we're getting cash. How much cash are we getting? We're getting the 1,000 shares times the $20 per share price. So our debit will be $20,000. Now we're going to also credit common stock here. Common stock gets credited for the par value. So that's where we're going to take the 1,000 shares times the $1 par value per share, and we get a $1,000 credit. Now, we're going to also need a credit to make this journal entry balance, right? It's going to be for the difference. And the account that we're going to use is something like additional paid-in capital. The actual account title will vary from company to company. It could be additional paid-in capital in excess of par value, or something slightly different, but that's the idea behind it. That is an equity account. And what we're going to do here is calculate the difference. What do we need the credit to be? It's going to be everything above par value. In this case, it's $19,000. And that's how we issue common stock at a price above par. So how does this impact our balance sheet? Well, again, cash is increased, so assets go up. And stockholders' equity is also increased. Both common stock and additional paid-in capital are both stockholder equity accounts. And then let's go through our last example here. Let's issue no par common stock for cash. So on July 11th, Fallon Corporation issued 1,000 shares of its no par common stock. The issue price was $5 per share. So if your stock is no par stock, the accounting for it's pretty easy. We're going to debit cash. It's going to be for the amount of cash that changed hands. 1,000 shares times the $5 gives us a debit of $5,000. The credit is common stock. If we have no par common stock, the entire amount goes into the common stock account. So that's how we issue no par common stock. The impact on our balance sheet? Well, cash once again is going up, so it increases assets, and common stock increases as well, increasing stockholders' equity. So what we've seen from this is if we issue stock in exchange for cash, it causes both assets and equity to increase. Okay, that's it. We're done. This video was created and narrated by Dr. Wendy Tietz. Have a great day.